Let me welcome you to the IEF Central Bank Summit. It's a real pleasure to have you all on this call today, and it's my distinct pleasure and honor to introduce to you John Williams, who's the President and Chief Executive Officer of the Federal Reserve Bank of New York. John became the 11th President and Chief Executive Officer of the New York Fed in June 2018. And, by virtue of this office, he is also the vice chairman and a permanent member on the Federal Open Market Committee of the Federal Reserve. Before joining the New York Fed, he was the president and chief executive officer of the Federal Reserve Bank of San Francisco, a distinguished economist with a long-standing career, wide range of publications, so somebody I know for many years in this area. John, welcome to the IEF, and let me pass the floor to you.
Yeah, thank you for the kind introduction, Axel. When the United States entered the pandemic in March, I never really expected that 3.5 months later, I'd be sitting here making speeches from my apartment. And I look forward to the day when gathering in groups is safe and we can meet in person again. So we're now 17 weeks into a catastrophic pandemic. It's cost over $500 billion worldwide, and it's had a devastating effect on the economy. Today, I'm going to talk about the current state of the U.S. economy, our goals for the recovery, and how the Federal Reserve is responding to the worst recession in memory. Now, before I continue, let me give the usual disclaimer that the views I express are mine alone and do not necessarily reflect the Federal Open Market Committee or anyone else in the Federal Reserve System. So the economic effects of the coronavirus have caused great hardship and created enormous uncertainty. At the root of this downturn, the global pandemic, means it's completely different kind of recession compared to anything we've experienced in the past. So as the pandemic unfolds, many people are starting to ask questions about our economic future. What will the recovery look like? When will we begin? And how will it be affected by the virus? Well, it's easiest to start with the last of these questions first. The virus will continue to be at center stage throughout the economic recovery. We're traveling down a narrow path, balancing a return of economic activity with effective containment of COVID-19. The overall unemployment rate reached nearly 15% in April, and around 20 million Americans have lost their jobs, numbers I hoped I would never see in my lifetime. And these figures understate the full extent of the pandemic's toll on the economy. The pandemic and the ensuing economic downturn have done disproportionate harm to communities of color. Black and Hispanic families, as well as lower wage workers, have suffered the most. And those who least can afford it have been hardest hit, making a strong and full economic recovery of paramount importance. As the recent surge in cases in some states demonstrates, much is still unknown about how the pandemic will play out in the months ahead. That said, there have been signs that we may be past the worst of the extreme economic distress, and early indications of recovery have started to emerge. Now, as states began to open up, and people return to eating in restaurants and shopping in stores, we've seen sizable increases in consumer spending. We've also seen increases in building permits and other indicators of the housing market, signaling a turnaround in that sector. People have been getting back to work, and the unemployment rate has started to edge down. Although this improvement is welcome, the economy is still far from healthy, and a full recovery will likely take years to achieve. Now, one of the things that's been really unique about this recession is the lightning speed of events. Traditional macroeconomic data sources, like the labor market report and GDP, are published with lags of weeks or months and don't typically allow one to see the changes within the month or quarter. So in response, economists of the Federal Reserve and elsewhere have increasingly turned to analyzing a wide variety of high-frequency data, which, as the name suggests, are published daily or weekly with only short reporting lags. High-frequency data give us more timely and granular information about what's going on in the economy in between the standard macro data releases. They also help us paint a more detailed picture of people's behavior and how it's changing in the midst of unprecedented circumstances. Now, these data tell us whether small businesses are hiring and whether people are eating in restaurants, staying in hotels, and boarding airplanes. Now, when states started to reopen, signs from both the standard macro data and the high-frequency granular data have been encouraging. Together, they indicate that we've likely seen the low point of the downturn. and that the overall economy has begun to recover. Even in New York, the hardest hit state, we have seen initial signs of a turnaround. Surveys of manufacturing and services firms rebounded significantly in June, following record lows in April and May. And revenues of small businesses in New York have gradually picked up as well. In contrast to these positive signs, we are seeing some indications of a slowing in the pace of recovery in those states that are currently experiencing large-scale outbreaks. Now, this is a valuable reminder that the economy's fate is inextricably linked to the path of the virus. A strong economic recovery depends on effective and sustained containment of COVID-19. Now, turning to the question of what the goals for the recovery are, well, one measure of success is a return to the sustained growth and historically low unemployment that we'd attained before the pandemic. I know this seems a long way from where we are today and may seem unreachable during these darkest days of the recession, but history teaches us that the economy can get back to full strength even after a deep downturn. Now, the unique nature of the recession and the uncertainty that comes with it means that the policy responses, public health, fiscal, and by the Fed, need to be designed to reflect the nature of the pandemic and the challenges it poses to the economy. Although I'll focus on events in the United States, it's important to stress that this is a global health and economic crisis. Most other countries are facing similar challenges and are likewise engaged in a range of policy actions. Our economic prospects are tied to our ability to contain the spread of the virus, care for those who fall ill, and develop effective treatments. In addition, fiscal policy has played a critically important role in providing financial support to families, small businesses, and those who are out of work during the crisis. This timely support contributed greatly to the rebound in consumer spending and jobs that we've seen over the past 2 months. The Federal Reserve has taken rapid and significant actions to stabilize critical parts of our financial system and to support the flow of credit, thereby helping position the economy for a strong and sustained return to maximum employment and price stability. In March, the Federal Open Market Committee, or FOMC, brought the target range for the federal funds rate to near zero. And the FOMC has indicated that it expects to keep interest rates at this level until it is confident that the economy has weathered recent events and is on track to achieve its maximum employment and price stability goals. Bringing interest rates down to near zero makes it easier for households and businesses and others to meet their borrowing needs and fosters favorable financial conditions that will help promote a rebound in spending and investment. In addition, the Fed's been conducting large-scale repo operations and purchasing sizable quantities of U.S. Treasury securities and agency mortgage-backed securities to support market functioning at a time of extraordinary volatility in markets. These actions averted a potential shutdown in the availability of credit, which would have made the current economic crisis far more severe. Although functioning in financial markets has improved since March, the Federal Reserve has indicated that it will continue to increase asset holdings to sustain smooth market functioning, thereby fostering effective transmission of monetary policy to broader financial conditions. In addition to stabilizing financial markets, the Federal Reserve has instituted a number of programs to support the flow of credit to households, businesses, and state and local governments. These actions will enable them to continue to do their work both now and when normal life resumes. Now, taken together, these programs have helped restore the functioning of financial markets, they've fostered favorable financial conditions, and support the continued flow of credit to businesses and households. So I'll conclude with this. This pandemic and this recession form a pivotal moment for the Federal Reserve. We're seeing signs that the economy has started to recover. Still, the economic outlook remains highly uncertain, and it's going to take considerable time to restore the economy to its full potential. But rest assured, we're committed to using our full range of tools to support the economy and bring about a full and robust recovery.
Thank you, John. And let me thank you also on behalf of all the members that the action taken by the Fed was really a key moment in stabilizing markets. And looking at the last crisis that was just less than 12 years away, I'd like to sort of, if you allow, go into a bit of a discussion about the tool set of the Federal Reserve and how this tool set and how it's being used at the moment compares to the crisis, tools that were developed then. I've been in a discussion with former Chair Yellen, and she said the advantage was all of these tools were sitting on the shelf, and some of them could just be reenacted. Others, and there are some tools that we will come to that are new lending facilities, were tailored to the situation. But as the sounding success of the Fed in stabilizing liquidity and the functioning of markets in March and April is clearly acknowledged by everyone that observed the situation, how do we have to think about this QE moving more in the direction of the QE type of programs, standard QE programs, where the guidance was a bit more longer term, where the program like QE2 and QE3 had a limit or a target for monthly purchases? How do you see the evolution of this crisis intervention, which was bold and successful, into a more day-to-day program that markets are used to and can use in their pricing of the way going forward?
Sure, and obviously, as you said, some of the facilities we've set up are very similar to the ones in the crisis, but many of them are quite different, and it's not quite as easy as taking it off the shelf and putting it out there. So it's a lot. Obviously, I just want to thank all of my colleagues around the Federal Reserve System for their hard work, working often 7-day weeks and 14, 16-hour days over the past few months to get that done. In terms of thinking about our asset purchases and how that fits into the broader, considerations, as you asked, we have been focused and we continue to be focused on making sure that, financial markets are functioning well. There's adequate or ample liquidity in, these key central financial markets, including the U.S. Treasury market and the mortgage-backed securities market. If those aren't functioning well, when those don't function well, then that will spill over and have negative repercussions to a broader financial condition. So our focus back in March and continuing to this day is making sure that we're keeping those markets operating well, functioning well, with lots of liquidity, and obviously that has positive repercussions for broader market conditions in the U.S. and around the world. In thinking about the future, potential possible future at policy actions, I think that really depends on where the economy is and where the outlook is going to be. We're in a time of just extraordinary uncertainty, both about, as I highlighted in my prepared remarks, about the virus itself, where there's, it's not certain what's going to happen with that, both in the U.S. and around the world, but also how the economy continues to recover and what that looks like. So from my point of view, we need to really do, the three things. One is figure out, diagnose, what is the situation, get a much clearer picture, hopefully over coming months, about where the economy is and where it's likely to be headed. And then, come up with the best policy choices that will foster conditions that will speed a strong and sustained economic recovery and achievement to our maximum employment and price stability goals. The situation is so much in flux now in terms of the virus, the economy, and everything. I think it serves us well to collect more evidence, data, understanding of what the likely scenarios are, and then design our policy choices appropriately to achieve our goals. And so right now, we're again with our purchases focused very much on market functioning and the transmission of the low interest rates to the broader economy, which has gone well, as you indicated. And then we'll be continue to think about as we get greater clarity about the outlook, about how we should best use our tools as we've committed to do to achieve our goals.
Right. And let me ask you about another part of the programs. Of course, you said rightly so that the Fed has got massive outright purchase programs traditionally in the toolbox. In Europe, a lot of the crisis response was about lending facility. The Fed has also introduced some new lending facilities, the municipal, the Main Street, and the corporate credit facilities. The pickup of those hasn't been tremendous. But the Fed seems very sanguine about the use of those. So are they more an insurance tool that is available? In Europe, we measure a lot of the success in how the programs we designed are taken up by the amount of credit that is originated by opening these facilities. So could you put that in perspective a bit to your sort of outright purchases and how you look at these lending facilities, particularly the new ones?
Yeah, it's obviously a lot of work went into standing up the facilities, the various corporate and the money market facilities on one hand, the Main Street facilities, which are now just getting up and running, and the municipal liquidity facility and the others. And, what we've seen so far was some uptake back in early days with the facilities that were stood up right away, but that's come down over time. And we've seen very little uptake in say for the municipal liquidity facility, and in others, and I think it's just a sign of success. So getting to your question, these are we weren't trying to replace the private sector in terms of providing credit and lending into these markets. We're really making sure that the markets are functioning well, that liquidity is available in the markets, and that's one key objective that I think we've seen a lot of improvement in those metrics. And the second is really in terms of a backstop, that whether it's on the corporate credit or the commercial papers or the municipal liquidity facility, that we're there if needed. But now the financial conditions have improved so much and liquidity is ample and markets are functioning well, those borrowers are finding that they can borrow at scale and at reasonable, very low interest rates in the private markets. So to me, it's a sign of success. No one's coming to our shops. You might say, well, it's not working, but actually it's a sign that's been working really well, because of course these facilities here are really, the goal is to support market functioning and the availability of credit. We've seen a sizable increase in borrowing and bond issuance, since markets have calmed down, since we've announced and instituted our programs, and companies that are taking advantage of the availability of credit and preparing for what is a very difficult situation with the crisis. And again, we're seeing on the state and local governments is a similar thing, where credit is available and at a relatively low interest rates. So to my mind, so far these are signs of the improvement in financial market conditions, of improvement in availability of credit, but we are there and ready if conditions worsen, if anything happens that makes it so that credit is harder to find. Our facilities are up and running and obviously play an important, if you will, backstop role in that situation. And I think that's added to market confidence and eliminated some of the tail risk that people were worried. What happens if markets freeze up, and where will that leave me, and how should I prepare for that? So that's how I view those questions.
Yeah, and we're seeing a similar phenomenon in Europe, where basically the credit is arranged, but the drawing of the facility is just a fraction of the amount that was actually negotiated. And so it just sits there in case it's needed. John, I mean, in a crisis as you intervene, the numbers and the bold action speaks for itself. As the imminent phase of crisis intervention, we get through that, markets look for guidance, forward guidance, whether it's guidance on the QE program, size, number, timing, or yield curve control, which is a sort of instrument that other central banks have used. Lael Brainard has talked about front-end yield curve control. The Federal Reserve has worked on these areas for many, many years. So around interest rate, I had two questions. The first one is, the perception of investors seems to be that as far as negative interest rates are concerned, that the Federal Reserve does not contemplate that as an imminent tool to be activated, unlike in Europe, where most of the countries, and in Japan, where that is used. So is that a perception that you share, that the instrument might have some features that are less desirable for a large capital market economy like yours? And the second one is on yield curve control, which basically is a form also of forward guidance. Can we expect any developments on that front in the Federal Reserve toolkit over the next couple of months and quarters?
So Axel, you on the first question on negative rates, I think you highlighted a very important aspect of our financial system, which is a hybrid system of both an important banking sector and also capital market sector. And so I think when you look across jurisdictions, and think about the different monetary policy tools that they've used over recent years and today, it is really being tailored to the particular economic conditions, but also the financial market institutional structure there. So I think different jurisdictions have used different tools based on the appropriate choices for the situation they're in. In terms of negative interest rates for for us, we've looked at that as you know in the past. We studied that carefully following the financial crisis. We've analyzed the evidence from Japan and from European countries. And the conclusion I personally draw from that is that there are other policy tools that you've mentioned, whether it's asset purchases that are primarily designed to hold down longer-term interest rates, or forward guidance, which is really about managing expectations and guiding market expectations of the federal funds rate over coming years. I think those are our most powerful tools. They've proven to be effective in the past decade or so, and I think they're well tailored for the economic and market financial market situation that we're in. So I think of negative rates as something that we have other tools that are, I think, very powerful, and we have a lot of confidence in. So we don't need to use negative rates in the U.S. in the circumstances we're currently in. That doesn't mean that you would never ever use any of your tools, but I personally think that forward guidance and asset purchases are our most effective, most proven tools, and are preferred to using negative rates in the kind of situation we find ourselves in. Now, markets want to know, they always want to know what we're thinking, what we're going to do, and they want to know when and how and the numbers and all that. And I think, I go back to my answer to the earlier question, is that, but really our policy decisions have to be driven by our view of the economy, the outlook for the economy in terms of our dual mandate goals, and obviously a very careful assessment of where the risks are. This is a risk management situation. Monetary policy is always kind of a risk management approach, but in particular today, we're very focused on not only what the baseline forecast is, but what the various scenarios, either more positive or more negative, may be. And so as we collect more evidence on that, get a better, clearer read of where the U.S. and the global economy is and likely to go, I think then we just need to use the combination of the appropriate tools to best support strong financial conditions, best support the economy to grow in a robust way, to get the unemployment rate down, get the economy much stronger, and get inflation back to 2% as best as we can. My concern really right now is is not so much where interest rates are today. If you look at yields out on the yield curve out of 10 years, rates are very low. I do think when we think about monetary policy strategy, it's not just about where do you want interest rates to be today, but really thinking about an overall strategy and a communications strategy that supports not only today, but over the next couple of years, very strong, favorable financial conditions and supportive and fostering a strong economic rebound. Now, you asked about yield curve control. I think I'm going to come out where I think you were leaning, which is yield curve control at the shorter end of the curve is really thought of, I think, mostly as a way to support or reinforce forward guidance of the federal funds rate, something we've studied and analyzed, obviously looked at what's happened in other countries around that. But no decisions are being made. It's just really making sure we understand, at least from my perspective, on making sure we understand what are our potential tools, what are the potential costs, benefits, pluses and minuses, and thinking through that. And as we really come up with a clearer understanding of this economic situation, obviously deploy the tools as appropriate to support our longer term goals.
Yeah, and John, I know that the Fed has been hyper-focused on how the labor market and how the economy is doing. And, it's fair to say that the last job report was quite an outlier relative to expectations. We've seen that the 2008-9 crisis scarred the economy very much, and the labor market took a long time to heal. And the Federal Reserve staying on an expansionary path allowed people to be crowded back into the labor. What is your current assessment, given also some of the volatilities in the numbers, on, do you work on the assumption that this will take a similar long time for employment to come back, or what is your assessment on the labor market and on the output side? How long will it take to go back to pre-crisis levels of GDP, and can we ever catch up with previous growth passes along those lines?
Well, I do believe we can get back to a very strong economy. I mean, I remember in every recession, there's always talk about we can't get, you don't get back to a strong economy. And like I said in my remarks, I'm confident that we can, and that's clearly a goal. In terms of the how I see the labor market and the economy, the pace of recovery, I think it's really hard to compare this to other recessions. Because this is such an extraordinary period. It's a period where, as a society, not just the United States, but obviously countries around the world, we are choosing, either individuals are choosing through their own behavior, or governments through various social distancing restrictions are choosing to shut down parts of the economy to limit and contain the virus, with the hope that with that we can get the economy back on track. So it's a very unusual dynamic. That's why we've seen the sharpest increase in unemployed and decrease in jobs, and that we've ever seen. But we've also seen an enormous, kind of shift in that in the last month or two. So I think that at least over the next 6 months, I'm not applying my standard, macro tools that you and I know very well, like Okun's law and things like that. I think it's just it's just such an extraordinary circumstance. That's why we're looking at a lot of these, high frequency granular data from, whether it's from, tech companies or from various things that follow, track, people's activities and things like that. Because I think it's such an unusual circumstance. I do think that some dynamic of recession type dynamic obviously will take place. It will take time for people who lose their jobs on a more permanent basis, or businesses that unfortunately fail to survive this episode. It will take time for the economy to heal. And on my own forecasts, and if you look at the forecasts from my colleagues from our last FOMC meeting that were published, sees the economy rebounding in the second half of this year, and with good growth next year, but the unemployment rate only coming down gradually, quite a bit this year, but then coming down gradually over the next few years. To me, one of the key goals of policy, and I would account this not just monetary policy, but also the actions of governments, is to limit this longer term damage to the economy. We obviously have to get through the pandemic. We need to be in a safe environment. But once that happens, to try to limit this longer term damage, which is really about jobs, matches being broken, businesses that are otherwise successful going out of business because of the unique circumstances. So that's how I see one of the key goals for us is to as best as we can get the economy, get people back to work as quickly as possible, and that will limit some of those kind of longer term factors that you are emphasizing. And I think that fiscal policy plays an incredibly important role in this, because only, of course, as we all know, we can provide liquidity, but it's the fiscal authorities, the elected officials, who are the ones who can actually provide transfers, grants, and other support to try to limit the loss of economic matches and other things that when they get broken are hard to rebuild.
Yeah, and that's where we're seeing on both sides of the Atlantic, that's where we're seeing a lot of discussion and some action emerging in Europe as well. I used to worry, and one of your predecessors, Tim Geithner, myself, and a few others have written a paper on the group of 30 about, we come out of the last crisis with some curtailing of crisis fighting tools. And so in this crisis, we seem to worry without a cause, because it seems to be bold action. Were there any tools that or authorities or powers that you felt would have helped in managing this crisis that the Federal Reserve didn't have, that might have been curtailed after the last crisis? What is your reading on the tools that you had and the broad use and the bold use you've actually encountered on?
Yeah, that's a really important question. Obviously, something we thought a lot about. And if you think about where some of the restrictions came out of the post-crisis era. It was, limiting the Fed's ability to lend to individual institutions. That hasn't been a factor at all. All of our programs are designed to provide credit and liquidity to broad market segments. So I think that, like you're suggesting, that kind of restriction that was put in following the crisis really isn't relevant. And any actions that the government needs to take around individual industries or specific firms can be done through the legislative process. Some of the other restrictions or changes were really about disclosure around emergency lending programs. And if you think back to the concerns that you and Tim Geithner and many had, it was really coming out of the financial crisis, which was centered at, in the financial institutions themselves, the weakness and fragility of the banks and other other types of financial institutions, and concerns about stigma, concerns about ability to intervene rapidly and decisively when you had problems in specific, say, banks. This crisis has been very different. The financial system, especially the banking system, came in much stronger due to the efforts of policymakers and governments around the world to strengthen capital liquidity and resolution processes. So all that work to strengthen the financial system is paying dividends enormously here in the US and elsewhere. And it means we have a much stronger banking system. We don't have the same issues that we had 12 years ago in terms of issues of the concerns or worries about the banks themselves, and the worries or the concerns are really around the non-financial segment of the economy, the restaurants, the hotels, all the parts of the business that have been shut down. And so I think that some of the limitations around these facilities really were focused on some of the things around the support for the banking institutions, and that's not where the issues have been. I think the other big change that I don't know if anyone could have anticipated is that Congress acted in the U.S. very rapidly, not only to provide income support and support for affected industries and businesses and the unemployed, but also providing capital to support the Fed U.S. Treasury lending facilities. And that is just a sea change from the experience of 2008 when the Fed emergency facilities, all except TALF, had to be done by the Fed, didn't have a federal government, explicit federal government backstop initially. And so this time, because of the strong action by Congress, which supported both the economy, but also provided a much better breadth and ability of the facilities that the Fed and the U.S. Treasury have put in place in this situation. And again, it's going back to remembering the history from the early period. That was something that wasn't there until TARP was passed, and that was obviously used in terms of supporting the economic recovery and institutions that were needed support.
And that's been on both sides of the Atlantic. Again, we've been here on the European side, bank have been very effective in helping channel because they were not impacted by the crisis in itself. The business we do is a very digital business, and we moved to a very digital modus operandi, even working from home, trading from home very early on. So the banks could be a facilitator in bringing money where it was most needed. And the business and the mix between government action and central bank action was much more balanced this time around, with governments immediately embarking on that. Still, financial stability concerns. I mean, New York Fed is also a key regulator, and I remember in the last crisis, many discussions around the Federal Reserve System were centered on the key market role the Federal Reserve you're heading now has played. Where do you see in terms of financial stability concerns? I hear a lot of issues when I talk to market players market finance per se, cyber on top of a system that is sort of being vulnerable, where working from home opens maybe cyber exposures, resilience in general, debt levels, limits of balance sheets, including the Federal Reserve. I mean, the chairman made a remark that nothing is without a limit. And so I hear many questions in the market. So where is your stability concerns when it comes to the broader financial system, not just the action the Federal Reserve has taken?
Yeah, and I would start again just to reiterate that the policies that were put in place, the much more stringent capital liquidity resolution planning requirements for especially the largest global banks, I think have been really critical. That there's in terms of not only having a healthy banking system, financial system overall, but also having that the world has confidence in that. In terms of things that keep me up at night, you identified one, and I would put it under, like you did, under the broad category of resiliency. We are stress testing our work from home environment in not only at the Fed, but obviously the banks themselves across the world are doing that. Does obviously cause us to be very focused on making sure that that environment is safe, that proper compliance and risk management are still being carried out, even when employees, workers, and banks are not physically together. But I would really emphasize what you did, which is the cyber risks. Those were a high priority for us before COVID, focus on cyber risks in the financial system, actually also a focus on cyber risks more broadly with the payment system in our own systems. And so a very high priority for everyone on that, and a lot of very good work, and really tying that to financial stability. I think sometimes these things get put into different buckets, right? There's financial stability, which is about the health of the financial system, and cybersecurity, some kind of IT kind of issue. But clearly, we at the New York Fed and others around the world have connected those dots and shown how risk to cyber risks in the financial system can, under some circumstances, create risks to the financial system, and making sure we understand that and prepare for that. Again, thinking about that at a time when everybody's working from home, relying on technology to support us, means that this is a particularly important issue for us. The other one I would bring up is the one that we've talked about for a long time, and that a lot of the financial system, a lot of the large scale kind of assets movements and parts of the financial system have moved out of the traditional commercial banking sector into what we used to call the shadow banking sector. And that's an area that's not as well regulated, not as well understood in terms of data and the risks out there. So again, we've been very focused on watching what's happening outside the traditional banking or regulated banking sector, and understand developments in those markets and in those entities. And I think that's an area, honestly, as we get out of the COVID period and look back and think about, what are the lessons from this? Clearly, some of the volatility and risks in the financial system exist outside the regulated system, and have to be studied carefully and thought carefully about how to make sure that the entire financial system has a level playing field, but also that we have good understanding and appropriate regulation of that.
Let me just second your point about cyber. We at the IIF are working a lot as an industry with law enforcement and with the authorities, because it always depends what you attach to the word cyber. If it's cyber crime, it becomes pretty obvious that there is a need for a public-private partnership, because like with regular crime, institutions themselves cannot protect against it just as an IT issue, as you mentioned. So I think this is important, that the industry keeps working with regulators and with central banks and law enforcement on basically preventing cyber crime. And the more we open our systems up to working from home, trading from home, the more these vulnerabilities in general increase. And we just got to work together to make that work. You mentioned the shadow banking or market-based finance as a system. I can't resist to ask a question that I'm on a panel with Christine Lagarde on Saturday, and her task is to talk about greening the purchase programs of central banks. So basically, rather than just the outright purchases, put an element in that basically gives some priority or somehow reflects the need for also a structural change in finance to sustainability and ESG. Is that a debate that the Federal Reserve is having in parallel to the European debate, or is that something where you would be much more cautious to dilute and to mix various objectives of monetary policy here with other political objectives?
That's a loaded, a loaded question with lots of different aspects. I think, the Federal Reserve Act is actually quite clear on what we can buy for the open market operations, our balance sheet in terms of U.S. Treasuries and agency, securities. So we're quite limited in that. And those are the kind of securities, obviously, we operate in currently actively. In terms of our various lending programs and facilities, we are providing credit to the broadest possible set of borrowers within the eligibility requirements that the law stipulates, and also the requirements that the law has for making sure that we're secure to our satisfaction in terms of risk. So, we're at least from my perspective, the approach that we're taking is to support the overall economy, get Americans back to work, get back to our maximum employment and price stability, and we'll leave that to elected officials to make decisions about how to best make decisions, that relate to other policies, whether it's climate or other issues. And what we're doing is really focus very much on our job of trying to support the return of the economy, return of people back to work, and within the, following very carefully the requirements of the law, the Federal Reserve Act, the CARES Act, and everything, in doing that exactly the way I think it was intended, which is to really support the broadest liquidity and provision of credit to the economy.
Yeah, thank you. And just a very quick one, we've got about 2 or 3 minutes left. The Federal Reserve, and I know you personally, has written quite a lot of papers on inequality, and even like after the last financial crisis, inequality has increased. What's your take? Has this again been something the current COVID and crisis we're facing in, where inequality is increasing further, and how concerning is that for you in the acceptance of policy tools being used?
Well, the increase in inequality in the U.S. has been going on for decades, and it's the COVID crisis has only highlighted how bad the inequality is, and especially how hard hit communities are that are, like I said in my remarks, least able to basically least prepared to deal with that. So I do think this is a reminder about the importance of this issue, both in terms of the long-run health of the economy and our society, but also just get a very basic question about, when you think about how do we achieve our economy's potential, how do when we have this idea economists have, there's this potential for the economy, and clearly we're nowhere near that. We weren't even near that before COVID hit, and the answers to me in terms of inequality really go back to investments in education, investments in various infrastructure and other things that help all Americans have a strong economy and benefit equitably from that. So I do think that's been an issue we've been very focused on over the past few decades. It's obviously something that is a longer-term issue, not just related to recent downturn, but the recent downturn, because it's had such a disproportionate effect on the lowest income communities, has just highlighted how exposed they are to an economic downturn of this time.
Thank you, John. And I think one reason why they get me in as a Swiss chairman is to end on time and to start on time. So we've come to the end of the 45-minute. Thank you very much for making yourself available. And as always, a pleasure discussing economic and monetary policy issues with you. So thank you very much for doing that. And to all that are tuned in, you're welcome to stay tuned here for the next conversation basically on top of the hour, Tim Adams will talk to Agustin Carstens, who's the former governor of the Central Bank of Mexico and who's now the general manager of the Bank for International Settlements. So stay tuned on the full hour, Tim Adams and Agustin Carstens. Thank you for listening in.